Welcome back to Gold Rush Reporter, your trusted source for independent gold and silver analysis, where we cut through the noise and focus on the facts. I'm Conrad, and today we're diving into another wild day in the silver market that proves this rally is far from over. You're going to see why even minor headlines can trigger huge swings, and why understanding the underlying forces is essential for anyone involved in precious metals. Today, silver saw incredible volatility. Early in the session, the price dropped as low as 86.36 before rebounding to a high of 93.64. Right now, silver is resting at 92.43, meaning it has recaptured most of its losses. That's just a 1% decline on the day, but the range between the low and the high was more than 70, a massive spread that underscores just how unpredictable this market has become. The volatility isn't random. We've seen multiple forces at work: geopolitical uncertainty, fears of tariffs, supply constraints, and technical factors in trading. One major event driving market chatter is a recent announcement from ATMEX, a key bullion dealer. Initially, I misinterpreted their statement, thinking there was a $10,000 minimum order for all transactions. After reviewing it carefully, it became clear that the restrictions were specific to buybacks, not new purchases. This clarification is important because it reflects the strain across bullion dealers. High demand, low supply, and logistical challenges are creating pressure on all sides. Silver's movement today isn't just about individual dealer announcements. It's tied to broader US policy and trade dynamics. In recent proclamations, the White House confirmed that it would not impose tariffs on processed critical minerals, including silver. Instead, the administration is negotiating trade agreements to ensure the US has reliable access to critical minerals while mitigating supply chain vulnerabilities. The Secretary of Commerce recommended options like adjusting imports, negotiating with foreign nations, or potentially imposing tariffs if agreements aren't reached in time. This mix of assurances and conditional threats adds to market uncertainty. Traders react to both the risk and the relief simultaneously. From a supply perspective, US production of critical minerals is insufficient to meet domestic needs, meaning raw materials are often exported, refined elsewhere, and imported back as finished products. This creates vulnerabilities in industrial supply chains, particularly for metals like silver, which is essential for electronics, solar panels, and other high-tech applications. The recent announcement from the White House helps calm fears of immediate tariffs, but reminds the market of the ongoing dependency on foreign processing, which continues to support prices. Technical trading factors also played a role today. The CME Group recently adjusted margin rates and introduced 100-ounce silver futures contracts, which are settled in cash rather than physical silver. These changes influence liquidity and trading behavior, potentially supporting higher price levels as more investors participate. With these factors in play, the day's rebound from lows near $86 to highs above $93 shows market resilience. Even with a 1% daily loss, the silver market remains strong and reactive to news, signaling that the current bull trend is intact. Finally, remember that volatility is not a weakness here. It's a symptom of a market adjusting to structural realities. Industrial demand, geopolitical risks, and trade policy changes all interact to create sharp daily moves. Investors and collectors alike need to be aware. Patience and careful interpretation of announcements are key. Misreading statements like ATMEX's initial letter can lead to confusion, but understanding the context helps make sense of why silver can swing so dramatically in a single session. Continuing from yesterday's volatility, let's take a closer look at the broader factors keeping silver prices elevated, even when short-term dips occur. One key driver is the global supply-demand imbalance. While US silver inventories are recovering somewhat, physical silver remains tight in many markets. In particular, China a major player in silver refining and exports, has restrictions that create bottlenecks. Export licenses are reviewed every 2 years, and while there is no outright ban, smaller companies face challenges, leaving only the larger refiners in operation. This keeps market supply constrained and helps maintain upward pressure on prices. Even when minor declines happen, like today's early drop to $86, the market rebounds quickly because demand outpaces available supply. Industrial consumption, especially in high-tech sectors like solar energy, electronics, and EV batteries, continues to accelerate. Silver isn't just a precious metal for investors, it's a critical industrial component. Any slowdown in supply triggers rapid reactions from traders who recognize that industrial demand will continue to grow. That's why even modest dips are often absorbed quickly and followed by sharp recoveries, like the jump back above $92 today. Bullion dealers are feeling the pressure too. High demand and limited supply are causing strains in operations, from order fulfillment to buyback policies. ATMEX, for instance, clarified its buyback language after initial confusion, highlighting that minimum buyback amounts are now set at $10,000. Retail customers can still buy silver in smaller amounts, but the adjustment shows the logistical pressures dealers face. Orders may take longer to process, and delays in shipping are becoming common. For investors, this underscores that physical silver isn't as instantly liquid as paper or ETF holdings, and patience is required when navigating this market. On top of industrial and retail dynamics, policy decisions in the US are adding another layer of complexity. The Trump administration's recent statements about tariffs, processed critical minerals, and trade agreements have eased immediate fears, but also remind the market of potential risks. Even though gold and silver were exempt from the global tariffs imposed previously, the threat of future restrictions has already affected stockpiling behavior. Market participants maintained elevated inventories throughout 2025 to hedge against potential tariffs, which created additional short-term supply pressures. The volatility we're seeing is a natural reaction to these overlapping factors: industrial demand, bullion dealer constraints, and trade policy uncertainties. While some commentators interpret spikes and dips as signs of instability, a closer look shows a market that is structurally resilient. Spot prices quickly recover from temporary declines because underlying fundamentals, physical scarcity, global industrial demand, and investment demand remain strong. In addition, technical trading adjustments play a role. The CME Group's introduction of 100-ounce silver futures contracts and floating margin rates increases participation while limiting direct physical settlement. This creates liquidity in futures markets without necessarily adding to immediate physical supply, allowing price signals to adjust rapidly in response to news and policy changes. The combination of physical constraints and technical trading dynamics explains why silver moves sharply, even on what may seem like minor headlines. Finally, understanding geopolitical and macroeconomic context is crucial. The US continues to rely on imported processed minerals, including silver, to support industrial needs. Any disruption to global supply chains, from tariffs, trade negotiations, or export restrictions in China, can have instantaneous effects on US prices. Investors need to watch both domestic policy and international market developments, as these can amplify price swings in a market already under strain from high demand and limited supply. Now that we've covered supply pressures and policy impacts, let's focus on how investors and traders are reacting to this volatility, and why understanding their behavior is key for navigating the silver market today. The first point to note is that short-term traders are being whipsawed. In a single trading session, silver moved from 86.36 to 93.64, a swing of over $7. Many traders who tried to sell during the low were caught off guard when the price rebounded quickly. This kind of movement punishes hesitation. As we've seen repeatedly in this bull market, silver doesn't offer the luxury of waiting for a perfect base to form. Those who sold in panic often had to buy back at higher prices, losing both time and opportunity. Conversely, long-term holders benefit from this environment, but only if they maintain patience and resist reacting to daily swings. Physical silver investors, in particular, are seeing the value of holding during volatility. With bullion dealers under strain, like ATMEX limiting buybacks to $10,000 minimums, it's clear that physical supply is tight. This makes staying committed to long-term positions more profitable than trying to time intraday swings. Another factor driving investor behavior is industrial demand and strategic stockpiling. Many market participants anticipated tariffs or restrictions and increased their holdings earlier in 2025. Even with the Trump administration confirming that processed critical minerals like silver won't face immediate tariffs, these prior actions continue to support high prices. Investors who prepared for worst-case scenarios are now positioned to benefit from market rebounds, while others scramble to catch up. From a trading perspective, technical market structures amplify volatility. The CME's 100-ounce futures, contracts, and floating margin rates allow more speculative participation without immediately impacting physical supply. These instruments attract traders looking for quick profits on intraday swings, which adds volume and magnifies price moves. When combined with real-world supply constraints and industrial demand, this creates the perfect storm for sharp daily spikes, like the $7 move seen today. It's also important to consider international markets, particularly China. Chinese silver prices remain significantly higher than US prices, reflecting strong domestic demand and supply management. While export restrictions are not a ban, they create perception-driven pressure. Traders respond to news, rumors, and policy interpretations, often exaggerating price reactions. The result is a market where even small announcements, like ATMEX clarifications or minor regulatory updates, trigger rapid price adjustments. Investor psychology plays a central role as well. Fear of missing out, FOMO, is real in a market where momentum is dominant. As silver approaches new highs, more investors feel compelled to enter the market, which fuels upward price moves. Meanwhile, those who hesitate often find themselves priced out, reinforcing the cycle of volatility. This creates an environment where silver prices react not only to fundamentals, but also to collective behavior, making timing secondary to understanding market context and trend. Finally, one key takeaway is that this market doesn't behave like traditional commodities. Unlike copper or lead, which eventually stabilize after large moves, silver is experiencing structural constraints combined with monetary and industrial pressures. This means sharp swings may continue, but they are part of a broader bull trend rather than isolated shocks. Traders and investors must adjust expectations. Volatility is normal, and quick rebounds after dips are not anomalies. They're the new standard. Now that we've examined volatility and investor behavior, it's time to step back and see how silver's movements connect to the broader financial system. This perspective is essential for understanding why the bull market may continue despite short-term swings. First, let's look at US monetary factors. Silver isn't just a commodity. It's historically a monetary metal. Central banks, particularly the Federal Reserve, indirectly influence silver's value through interest rates, bond markets, and liquidity policies. Currently, US Treasury bonds are showing stress. Long-term rates remain elevated, and prices have not recovered from previous declines. When bond markets are vulnerable, confidence in fiat currency weakens, and investors increasingly turn to tangible assets like silver and gold. This dynamic reinforces demand, regardless of daily price swings. Next, consider industrial demand combined with supply constraints. While supply in the US is slowly recovering, physical silver remains tight globally. China, as a dominant refiner, continues to manage exports carefully. Even temporary restrictions on smaller refiners create global ripples, affecting liquidity in London and other international markets. The mismatch between industrial consumption and available supply keeps prices buoyant. Solar panels, EV batteries, semiconductors, and medical technology all consume significant amounts of silver, and these sectors are expanding rapidly. This structural demand is unlikely to slow, even if minor price corrections occur. Now, let's examine the role of bullion dealers and trading infrastructure. Firms like ATMEX highlight the pressures within the physical silver market. Clarifications on buyback limits, minimum order requirements, and shipping constraints show that the supply chain is under stress. For investors, this is not a sign of weakness. It is evidence of high market engagement and strong demand. Physical silver is being held, sold selectively, and circulated slowly, contributing to price stability over the medium term. Silver's interaction with futures markets also matters. CME groups, 100-ounce contracts, and floating margin rates create flexibility for traders while keeping physical silver in tight supply. These contracts allow for price discovery and liquidity without depleting the physical market, meaning futures can spike or drop quickly while the underlying metal remains constrained. Understanding this difference is critical for investors. Short-term swings do not necessarily indicate a collapse of the bull market. On a global scale, geopolitical factors and trade policy further support silver. The US decision not to impose tariffs on processed critical minerals eased immediate fears, but ongoing trade negotiations and supply chain considerations keep the market alert. Investors respond to perceived risks as much as real ones. Elevated inventories, careful stockpiling, and rapid reactions to policy statements amplify volatility, creating the price swings we see day to day. Another factor is monetary inflation pressures. With central banks continuing to expand money supply, the value of paper currency is gradually eroded. Silver acts as a hedge against these pressures. Long-term investors recognize this, and industrial users remain reliant on consistent supply. When combined, these forces create a market that is resilient to short-term corrections, but highly sensitive to systemic signals. Finally, consider historical precedent. Past bull markets in precious metals, like 1976, 1980, or 2001-2011 for gold, demonstrate that strong structural demand and monetary pressures often lead to extended rallies despite temporary pullbacks. The current market mirrors these conditions: constrained supply, growing industrial and investment demand, and macroeconomic uncertainty. Price dips are absorbed quickly, rebounds are sharp, and overall momentum remains positive. As we wrap up our analysis, it's clear that silver's current bull market is not just a short-term spike, it's part of a larger structural shift. Today's volatility, while dramatic, reflects deeper forces at work: constrained supply, growing industrial and investment demand, and macroeconomic pressures that are unlikely to fade anytime soon. The first takeaway for investors is patience is critical. The swings from $86 to $93 in a single day highlight the risks of reacting emotionally. Short-term traders who panic sell during dips often find themselves locked out of subsequent rebounds. Long-term holders benefit from staying in position, as silver's fundamentals continue to support higher prices over time. Understanding the difference between noise and signal is crucial. This bull market is being driven by structural changes, not temporary headlines. Second, supply constraints remain a defining feature of this market. US inventories are recovering slowly, but the global silver supply chain is tight. China remains a key player, with refined silver exports controlled and monitored. Meanwhile, physical bullion dealers are under strain. ATMEX's buyback minimums, shipping delays, and product limitations all reflect the pressure on supply. These issues may cause temporary fluctuations in price, but they also validate strong underlying demand. Industrial consumption is another critical driver. Solar panels, electric vehicles, semiconductors, and medical applications consume significant amounts of silver, and demand is accelerating. Unlike some other metals, silver cannot be easily substituted in these applications. This ensures that industrial demand will continue to support prices, regardless of minor policy changes or short-term corrections. Monetary and macroeconomic factors amplify this effect. Elevated interest rates, stressed bond markets, and global uncertainty push investors toward precious metals as a hedge against inflation and currency risk. Silver's dual role as both a commodity and a monetary asset makes it uniquely sensitive to these dynamics. As confidence in fiat currencies wavers, demand for silver as a store of value rises, supporting both price stability and momentum. Policy decisions also shape market behavior. While tariffs on silver have been avoided for now, investors remain alert to potential future restrictions or trade shifts. Even perceived threats can trigger buying, stockpiling, and volatility. Market psychology reinforces these trends, creating a self-sustaining bull environment. For traders, futures markets continue to play a key role. CME contracts, floating margin rates, and cash-settled instruments provide liquidity and speculative opportunities without depleting physical supply. This allows prices to move quickly, creating sharp intraday swings. Understanding this distinction is essential. Futures volatility does not mean the underlying bull market is over. Looking forward, the pattern is clear. Silver is entering a new reality, one where prices are likely to reach levels well above previous ranges. Historical comparisons support this. Prior bull markets in precious metals demonstrated that structural demand, combined with monetary and industrial pressures, often result in sustained rallies with intermittent corrections. Temporary pullbacks are normal, but they are absorbed quickly, reinforcing upward momentum rather than derailing it. In practical terms, investors should focus on long-term positioning, patience, and understanding market context. Avoid reacting to headline-driven volatility. Recognize that policy shifts, supply constraints, and macroeconomic pressures create opportunity, not panic. Short-term trading may offer quick gains, but the real value is captured by those who understand the larger trends at play. Finally, remember that silver is both an industrial metal and a monetary asset, giving it a unique place in the global market. As industrial demand grows and monetary uncertainty rises, silver's dual role will continue to support higher prices, driving this bull market into a potentially historic phase. To sum up, volatility will continue, but the bull market is far from over. The structural forces, supply constraints, industrial consumption, and monetary pressures remain intact. Investors who stay informed, patient, and disciplined are positioned to benefit as silver moves toward its new reality, potentially well above prior highs. Gold Rush Reporter will continue to track these developments in detail, providing insight, analysis, and updates so you can make informed decisions in this evolving market. Stay alert, stay patient, and remember, this bull market rewards those who understand the forces behind the metal, not just the price on the screen.